Morning, everyone, and thanks for taking time to join us for this flexible bond update. For those of you that don't know me, I'm Dawie Karstens, part of Prescient's business development team, and I'm joined by Reza Ismail, who's head of our bonds. As with all our webinars, please post your questions in the Q&A function, and we'll get to as many of those that we can at the end of it. And if we have any technical difficulties, just bear with us. Reza, there's certainly no shortage of things to talk about in the fixed income market at the moment, both locally and globally. I think globally it's still the usual suspects. Geopolitical events and tariffs are still hanging around, yet the US consumer seems quite unfazed or resilient, holding up their spending remarkably well. And then locally, we've heard the Reserve Bank governor floating the idea of lower inflation target, and the market, especially the yield curve, seems to have liked what it heard. And then, against that backdrop, Reza, I'd like you to take us through Prescient's approach, our systematic approach, and how we're navigating all of this and what it means for our funds, specifically the Flexible Bond Fund. And if there's some time left, maybe we can touch on the Bond Portable Alpha Fund, which almost has a one-year track record. With that, Reza, I'll hand over to you.
Thank you very much, Dawie, and good morning to all our listeners, to all our viewers. Always a pleasure to be sharing some thoughts with all of you. And the way I thought I'd conduct this session is to maybe spend sort of 5 or 7 minutes for the most, just contextualizing, all of the salient sort of determinants, or all of the things that are relevant to the South African bond market at present now. Dawie, in the very beginning, he did a great job of giving a little bit of a synopsis of the kind of forces that are in play, that are affecting the South African bond market. But let's just, give some more comments and flesh that out a little bit, right? So, broadly 3 headings before we get into the nitty-gritty of the Flexible Bond Fund. So broadly 3 headings that are driving the yield markets globally, right? And what are they? The first one is the specter and of tariffs. Okay, so we will say 2 or 3 sentences on that. And then there's the issue of global growth and specifically of somewhat slowing consumption in the US, right? So we need to address that also in 2 or 3 sentences. And then, as Dawie mentioned, a lot more proximately, there has been some pronouncements by the SARB governor with regards to the moving to a new point estimate inflation target of 3%. There's still some water that needs to flow under the bridge with regards to agreement by National Treasury to that point estimate. But to a large extent, the bond market, as we shall see, has largely assimilated that information already. Okay, so the first thing I'd like to talk about a little bit before we delve into our portal, and before I show you some interesting things about the flexible bond product, is this question of tariffs, right? So tariffs, of course, have been part of the toolkit of sovereign nations for many decades, and effectively they sort of rose to topical prominence at the time of Donald Trump's Liberation Day comments, and proposals in early April. Now, effectively, the language in which those tariff proposals were couched in, almost seemed to suggest that it's Donald Trump and his acolytes, their understanding that the US is somehow being taken advantage of by predatory behavior in terms of its big global trade partners, right? And the manifestation of that, is effectively a current account deficit on the part of the United States. And Donald Trump is now looking at measures to effectively redress that, right? And the idea is that he is imposing what is now referred to as bilateral tariffs to almost penalize certain nations, that has got the reciprocal image of a current account deficit. In other words, certain nations that have got a current account surplus, and he's hoping that by slapping quite outsized and in many cases preposterous tariffs on trading nations, that it will somehow alleviate this issue of of the US having a current account deficit. Now, essentially, the formula which Mr. Trump proposed as a supporting acts for his pronouncements are, by large consensus of academics and practitioners, mathematically baseless, right? They actually hold no genuine economic water, and that is because the current account position is largely a byproduct of savings and investment imbalances. There's actually an economic identity that governs that. So if a country is sort of investing more than it's saving, by necessity, it must have a current account deficit, right? And what we also know is a current account deficit needs to be matched by a financial account surplus, since the balance of payments need to sum to one. So importantly, the first point to take away is that there will, in fact, the way that tariffs have been proposed in the bilateral manner that it has will not actually address the current account deficit that the US actually finds it. It will not achieve the objectives that Mr. Trump thinks it will achieve. The current account deficit will remain largely of the same order, but the composition of its trading partners might very well change. Now, what that has meant for the second round effects in terms of inflation, what we do know is that tariffs are actually costs that are paid by the US consumer and by US businesses to the US customs officials at the point at which it enters the country. And the question is, will this be inflationary, right? And our take on it is that we also know as a truism that tariffs will affect the price level permanently, but only inflation once, right? And effectively, this is saying, if we look at longer term inflation expectations, the market has assimilated the statement that I just made, and we can see that longer term inflation expectations in the US remain unfazed, even in the face of these very punitive tariffs that Mr. Trump has announced, right? So you will very likely get an initial inflation spike, but then that will moderate downwards because it can only affect the inflation process once, and longer term inflation expectations remain fairly well anchored and remain unfazed by the prospect of tariffs. So that is just on the tariff story. The second thing that I promised to effectively mention is at the outset, before we dive into any graphs or any fancy analytics, is this issue of the growth patterns in the United States. Now, what is undoubtedly the case is that we do see a slowing consumption profile. If we look at real, sort of pieces of data, retail sales, vehicle sales, the state of household balance sheets, the net investment position of households, these all look fairly okay, right? So where there is an admittedly an element of disconnect is this idea of consumer surveys, which is generally referred to as soft data, right? So there's a massive disconnect between soft data estimates of where the US economy is. For example, there's a very famous Michigan consumer expectation survey that has sequentially been printing very weak. In other words, the expected conditions that US households perceive there to be is quite weak and muted, but that is, in contradistinction to that, you have actual real data, what they are actually buying, what businesses are actually producing, what they are actually buying themselves, seems to be quite resilient, right? So you have a disconnect between hard and soft measures of where the US economy is. And that is a theme that we will likely see, playing out in the months to come. There's an element of apprehension. There's an element of consumption smoothing on the part of households. But thus far, there's been no large-scale capitulation, right? So for sure, the US economy on real measures is slowing somewhat, but we'd be very careful, before we bandy around terms like outright recession and very deep and prolonged recession, right? So that's just a story on US growth. So having said that and almost sort of painted a picture, I would just like to share my screen and hopefully, let's just say, hopefully all our viewers can see that. I would like to start off by move this away. Sorry. Sorry about that. And effectively just take you through effectively our position and our thinking with regards to everything that I've said now, but with regards to our active bond view, right? So as you know, Prescient is a systematic house, and the way that we effectively think about the management of bond portfolios is described systematically or rather pictorially via the screen that you see in front of you. So it's largely a 6-step process, starting with our investment stance on bonds, which then filters down to an expected return per bond per state of the model. I'll explain what that means in a short while. We do risk management and portfolio optimization in the same step. Hopefully there's time to get to actually showing you that. And then, as a little bit of sweeteners, we consider the nominal versus linker question and other alternative sources of alpha. For example, we may look at some credit names and enhancements, of that order, right? So a 6-step process, and effectively what we try to do is we try to answer a very simple question, and that is, what are the long-term determinants of the South African bond market, right? Now, if I were to just give you a small anecdotal flavor for what we're trying to do, let's just say I'd like to create a model that predicts how a first-year student is going to perform in their mathematics course, during their first year of university, right? So a student is registered at UCT Upper Campus, and I'd like to almost model what that student is likely to do in mathematics in their first year. Now, a very strong determinant of how they would perform in mathematics in first year might very well be what their matric maths mark was, right? So that is a determinant. That is a factor which is measurable, that has got a time series across different students, and that can be proven to have predictive relevance. Generally your A students in matric very, very likely turn out to be quite strong students in mathematics in first year at Upper Campus at UCT or whichever other university they are at, right? So the matric math mark becomes a determinant, becomes a factor of relevance. A second one might be, let's just for argument's say, the distance that you stay to your university. Long distances away from campus often mean that you have a lot of missed lectures, and that also has a bearing on your marks, let's just say. So one can very easily identify 2 or 3 good factors that have got very good predictive relevance as to how a student's going to perform if you look at their matric maths mark and perhaps their distance to campus. Now, in the same way, we try to do the same exercise for the bond market, identifying what we think are going to be factors of relevance that are going to have predictive power for what the bond market's going to do, right? But instead of just hypothesizing what those factors are, we actually have a statistical test that tests a number of variables, and that essentially comes up at the end of that exercise with this factor mosaic that you see in front of you. And this is nothing more than a collection of factors that has been proven to have predictive relevance for the bond market, in the same way that my previous students' grade 12 maths mark had predictive relevance for what they were going to do in first year maths, okay? One of these, if I click on any one of these things, for example, the factor that relates to the term premium, you will see another screen opens up. And this is our way of effectively assimilating that data. So it's saying that, okay, I've got a time series called term premium, and I can see that at the onset of COVID around 2020, we've got a massive jump in term premium. It almost doubles in size. It sort of hovers around that area until about mid-year last year, when we had sort of the formation of the GNU. So then the term premium actually reduces. Note very carefully, I'm not saying that the GNU was the cause of the term premium moderating. I'm just commenting on 2 events that happened at the same point in time. You have that moderating, and then also now you see quite a significant leg down in the term premium, right? But still, you would agree that it's still at quite an elevated level if we just look at the endpoint of that graph relative to its previous history. So you would conclude that the term premium is elevated, and because of that, it actually has this blue shining color in the model, which actually says that term premium is high. So it's shining blue because it's making a case for us having more active duration in the model. Okay. Any factor that shines blue here is essentially saying I'm a factor that pulls for more active duration, right? A factor that shines red, for example, if we look at sentiment, the entire sentiment cluster, or if we look at the implied currency risk premium, or some factors that relate to financial conditions, some of these are shining red because they are saying, actually, even though you have quite a high real yields and high term premium, one should exercise some caution because there are other factors that is pulling in the opposite direction. That is effectively saying, no, you should be a bit circumspect and not go headlong into a very, very bullish position. You should just take some care, right? So these are the factors that we've pre-identified by a statistical process to have relevance, and each of them, depending on their various levels every day, this gets updated every day, will shine at different colors, right? And the sum product of all of them, the weighted average of all of these factors, puts us on an overall stance, which as today you can see, we actually are neutral, almost straying into the moderately negative side of things. In other words, this is a time that the model is saying, actually, the yield curve is pretty fairly valued, if not even a little bit overvalued, a little bit on the more expensive side. But that's not too much of a surprise given the rather seismic moves that we've seen in the bond market, of late. And I'll chat to you a little bit about that specifically. Okay, so what we're saying, you understand that the way that we interpret the world is via a factor mosaic. That factor mosaic maps us onto an active duration stance that is summarized by the dial that you see in front of you. That in turn puts you into a state, the current state being neutral. And the way that we then move, we proceed from this step, which I'll show you in just a second, is that we move to a set of expected returns that is conditional on us having the score that we have registered. So that sounds like a mouthful, but what are we really saying? We're saying that every manager, every fixed income manager, every manager out there, they need to have some interpretive way to say, I need to summarize the world around me, and I need to assimilate that information into my duration stance. Okay. Now, that process can either happen subjectively, i.e. a qualitative process that exists largely in the heads of those portfolio managers, or that process can happen quantitatively or systematically in the way that I've now shown you, right? Where we are summarizing the world around us via this mosaic, via a statistical process that is free from behavioral biases and cognitive errors, and we're using that instead as a way to summarize the world around us and put us into a particular state, which I've shown you now is neutral. Okay. Now, what now happens is quite unique, is that if you see this navy blue line that I'm now hovering over, this is the line which summarizes what this dial would have been at any point in time going back to the mid-90s. So today we are in neutral. That's the last point here. But I can look back in the past and I can see at any date what this stance would have been. Okay. At certain times, I'm very strongly positive. In other words, I'm very constructive on bonds. On other times, maybe around 2013, I'm very anti-constructive. I'm very bearish on bonds, and so on and so forth. This explains what your stance was at any point in time. Now, the beauty of having a time series like this is that I can answer the question to say, if I am in neutral today, where I am, okay, can I examine all the other instances in which the model was also in a neutral score? For example, somewhere there, or maybe somewhere there, or somewhere there. There are numerous other instances in which the model in the past also registered a similar score as what it's doing today. And what I've then done is what we do here at Prescient. We say, can I examine what subsequently then happened to the yield curve in the 12 months that followed every other time I was in neutral? Okay, so if I look at all the other instances that I was in neutral, maybe that point now, remember, this is now in the historical past. So in 2011, I can say, okay, I was neutral. what happened in the 12 months after that 2011 period. There was also a time that I was neutral there, and so on and so forth. And based on that, I get a distribution that you see in front of you. I get a distribution of yield curve changes, right, in the 12 months that followed every other time that I was in neutral, right? So this is a distribution of changes. And what is it really saying? This thing is saying, as you can see, the mode of this distribution, or what value happens most, is it's sort of centered around zero. And that does make sense, because it's effectively saying when the model state is in neutral, you sort of not really, you're not really expecting any big changes to the level of the yield curve, because this thing is centered around zero, right? You're almost saying the yield curve is fairly valued. It's not really going to move up or down in any material way. The distribution is centered around zero, okay? If I was in strongly positive, the story changes, right? If the state of the model, if this dial was maybe somewhere there, somewhere strongly positive, based on the mosaic, of course. If this mosaic was shining blue in many of the places, this score would be more 3 o'clock-ish and strongly positive. And you would see that based on that, what the distribution is saying is that it's saying, if I was in strongly positive, there's a lot more distributional weight here that makes a case for the yield curve to compress. Because you can see here there's a big tail here to the left in which the average change is negative, i.e. the curve compresses. The change in the level of the curve is negative, i.e. the curve comes down, it compresses. And that makes sense, because when I'm in strongly positive, I expect that yields are now so cheap that the movement in the next 12 months must be that the yield curve will compress, right? And armed with this knowledge in turn, I am able to then calculate expected returns for every bond on the term structure. As you can see, there are a number of bonds over here. We've got everything from the R186, which in fact used to be the benchmark bond, to the 2032s, to the 2037s, and so on and so forth, right? And as you can see here, you essentially getting a situation where it's saying you sort of want to be in the belly area of the curve, and a little bit at the front end, because those are the two outperforming areas of the curve. You don't want to be at the back end, because the belly outperforms that. You don't want to be at the very front end in the 186, because there are other better parts on the curve to be. But the power of the model is that in any one day, I can simply fire up this model. I can switch on my computer, and effectively it will tell me what the expected returns are for every bond on the term structure. Now, that is massively powerful. And if you followed this thing up to now, you've done very well. But that is essentially the heart of what I want to tell you about how we actually do things here, is that we need a way of analyzing the state of the world. Okay, we do that via the factor mosaic. That factor mosaic allows us to actually move downstream and say, okay, conditional on us being in a particular state of that mosaic, what are my expected returns? If I were to be in strongly positive, things change. You get a lot more juice coming out of those back-end bonds if I was in strongly positive. If I was in moderately negative, you can see the returns become a lot more muted, because you're expecting in that state that the yield curve is going to sell off. That's the whole idea, right? But this thing defaults to what the current state of the model is, i.e. my reading today of where we stand, taking all the factors of relevance into account, and it produces these things. Now, you might come to me and say, Reza, but I think that there should be other factors in here that we think. Now you might not see these ones here, but this is now economics cluster, and this is wage growth and non-farm payrolls. And you might think that Reza, I think that the US fiscal deficit needs to play a role here. Or you might think that some other inward-looking South African factors, like our total hours of load shedding, should be a factor. Those are all good questions, right? And rest assured that we've tested over 300, actually now close to 400 different variables for predictive relevance. And rest assured that it's in fact these 12 or 14 factors that have actually been proven to come up as top of the class. Now, some of these factors some of these developments might manifest in other factors, right? So take the US fiscal deficit question, right? So as you know, there was a very big fiscal bill that was passed by Mr. Trump, and the likely effect of that is this last factor here, the US term premium. So if I were to click on this thing, you will see that this thing is effectively measuring the US term premium, which is and you can see that since 2020, it's only moved up. This is saying the compensation that one needs to get for buying a US 10-year bond has in recent times escalated or gone up because there is this element of risk now, because the fiscal position has become so stretched, and because the issuance of government debt is so pronounced. So it's actually saying that that whole fiscal question is actually measured by a variable that we know of, measured by the term premium, and so on and so forth. What you would find that if you almost think of any qualitative reason that you can, chances are they can be distilled and measured by a factor that is already in the mosaic, right? I'd like to just make that point. Okay, so moving on, you'll agree with me that the end product of this thing is that I've got a set of expected returns for every bond on the term structure, right? I can then move on to sort of the portfolio construction stage of things, right? And I'll quickly show you. This will just take some time to load. But the first thing to note is that the first thing the optimizer does is it says, okay, I know what the all-B weights are, right? These are these lavender color bars over here. This is the all-B weights, right? Factual from the all-B, okay? And then what we have that is effectively a target portfolio, and saying that, okay, taking all things into account, the expected returns, that Manhattan chart that I just showed you now, where you have all those bars stacking up, it's saying that your ideal portfolio is sort of a mixture of 2032s, 2037s, and the following signature that you see in front of you, right? But really the lion's share of it in the 2032s and 2037s, and that is not perhaps unsurprising, because of the fact that you actually see that those were the best performing areas of the yield curve in that previous diagram I just showed you, right? Now, I won't go into the sort of the rats and mice of how we effectively work this optimization, but there is an optimization that happens in which we trade off expected return under downside deviation, and we use that optimization to get to this target portfolio. Now, in a perfect world, my current portfolio should look exactly the same as the target portfolio. It actually doesn't at the moment. Reason being, we are on Monday today, and we had two very, very seismic days in the bond market on Thursday and Friday. Thursday, we had the MPC day. I'll come back to that in just a second, in which the bond market compressed about 30 basis points, was a massive move for the bond market on Thursday. Then you also had Friday, which was another strong day for the bond market. So actually what has now happened is that the market is, the model is receptive to those dynamics, and has said that actually, Reza, the yield curve has compressed. You were in these bonds here, the 209 and the 2035. I think it's time to take some profits and exit those positions and take up a position that is a lot more all-B centric, like the 2032. In fact, a little bit more front-end-ish, and basically curtail that position. So it will tell me exactly how I need to trade, what I need to sell out of. It's very reactive and very dynamic, depending on exactly how things evolve. So we notice the curve compresses, that will get picked up by the factor mosaic, real yields will come in, term premium will come in, it will give me a new score on that dial that I showed you, and that dial will feed through into expected returns, and downstream, it will take it into account into our optimizer here. So in terms of positioning, we now have quite a big presence, or the model wants quite a big presence, which we will trade to in the 2032 bond, but also maintaining a little bit of a barbell type of structure, some exposure, about 20% in the 2037s, and then we've got some sporadic exposures on the long end. That's all been optimized for the different ways in which the curve can evolve from here. Okay, so that is just a little bit of word on positioning. We have actually done quite well in terms of taking profits and effectively riding the crest of the wave, riding that compression downwards. We are effectively now going to sell out of those profit-making trades. and move a little bit into the front end in the form of the 2032, right? So that's just in terms of positioning, okay? One interesting thing that I'd like to show you is that you might want to ask me what was really behind this big move that we saw, you know, on Thursday after the governor spoke, and on Friday last week. And I'd like to show you this particular decomposition. And what it really shows you is that the 10-year nominal bond at the moment is trading at 9.6%. Okay, but we can sort of slice and dice that number up in order to ascertain different quantities that themselves in and of their own right can be studied. For example, I can cut up this 9.6 and separate that out into a term that relates to the term premium, and a term that relates to average expected short-term rates. In other words, what I'm saying is, if you look at this 9.6%, right, what this procedure is doing is saying, if I were to roll over a series of one-year bonds 10 times, right? You invest in a one-year bond, that matures. You invest in another one-year bond, that matures. You do this 10 times in a row, and then you take the average of your one-year rates. What answer would you get? You'd get to 6.9%. That's that component here, right? Now, if what is known as the expectations hypothesis was true, then this 9.6% and this 6.9%, they would be the same number, right? Because there would be no term premium. You know, in other words, a 10-year bond is nothing more than rolling over a series of one-year bonds 10 times, right? These two blocks would register the same value, and effectively there's no term premium. However, we know that that is not the case in practice. We know that there is indeed a term premium, and in South Africa, we saw that that can be quite high. And that term premium at the moment is about 2.7%. So what it's saying is you get a little bit more fat, you get more compensation for investing in the 10-year bond, as opposed to rolling over a series of one-year bonds 10 times, right? So you can see that there's compensation there. But we can carry out this procedure twice and effectively come up with four different quantities, four additional quantities that together, if I look at these red boxes and the yellow boxes, remember they've all been derived from quantities that were estimated in the previous step. And I can find that the 9.6% is the sum of the four boxes that you see in the extreme right-hand corner, okay? Now, for the purposes of this discussion and the interest of time, I only want to focus on the yellow blocks, right? The yellow blocks, one of them relates to the inflation risk premium, and the other one refers to average expected inflation that is embedded in that 9.6%. So you look at a 10-year bond saying 9.6%, that 9.6%, you know, is composed of several different quantities that I'm circling here. 1, 2, 3, 4, right? And two of them relate to inflation compensation, right? The first one is average inflation expectations, and the other one is the inflation risk premium, right? Both of these things are components, in fact, and the red boxes are components of this 9.6%. Now what has happened, right, is that at the May meeting, right, this was the May meeting of the MPC, this was the first time that the SARB governor started to talk about potentially moving to a 3% target. But immediately when that meeting concluded, we saw two components now, like this inflation risk premium number and the average expected inflation component. These two components of bond yields, they moved dramatically. They moved dramatically. Now, you won't be able to know this if you're only looking at the top level number, 9.6. You have to be able to do the exact econometric routine that we've done to split out the bond yield into its constituent parts, and then look at how things have changed. Now, by way of example, I'm just going to start sharing another screen. And this is, in fact, our Prescient on Point publication that I hope many of you have actually read. So if you read the Prescient on Point publication, right, that you come to an article that was written by myself on inflation targeting and sort of central bank credibility, right? But I just want to direct your attention to figure number 1 in that article. which basically says if I look in early May, the 10-year nominal bond yield was at 10.5%, right? Now, remember, I told you that the current value is 9.6. So you can see that the 10-year bond yield has almost compressed by a full percent, almost 100 basis points, right? Since the values in early May, okay? But importantly, just look at these two quantities that I've circled in red. The inflation risk premium was at the middle of May 1.1%, right? And average expected inflation. Remember, all of these things at the bottom are components of that 10.5%. But the inflation risk premium components, 1.1%, and average expected inflation that was embedded in the bond yield is 4.4%. Now, let's just go and see what happens at the end of June, right? At the end of June, that inflation risk premium has moved from 1.1% to 0.4%, right? So that is a big 60 basis point move. And the average inflation expectation has moved from 4.4% to 4.2%. That's another 20 basis points. So you've got effectively 60 basis points there and 20 basis points there. So what I'm saying is the components that relate directly to inflation and what is priced in with regards inflation have changed significantly in bond yields, in South African bond yields. And if anyone had to say, can you identify one reason alone why the bonds have compressed? And then you can go to them and you can say, I can prove to you econometrically via the work that Prescient has done to say that it's specifically the components that relate to inflation, i.e. the inflation risk premium and average expected inflation. Those two components that we've split out here, we can show how they have changed since the beginning of May to now, and prove that these were indeed the culprits that have caused the yield curve to compress. Okay. Now this can only happen if there is the widespread belief on the part of financial market participants that the South African Reserve Bank is credible, that if they say they want 3%, they will get 3%, right? Because their reaction function is so trusted. And this is the kind of arguments that I make in the article. I strongly suggest that you read that article. This one that you see in front of me. As you can see, it's titled "Inflation Targets, Risk Premium, and the Price of Credibility." You can go through the pros and cons of the move, but I'll give you the punchline. We think that is unambiguously, a very positive development for borrowing costs, for macroeconomic stability, for the SARB to actually move to that 3% target. Okay. Now, this, of course, needs to be rubber stamped jointly via consultation with the Minister of Finance, and there's some discussions that still need to happen. But just remember that the SARB already has got some kind of legitimacy with which to do this move already, by the fact that the current band is from 3 to 6%. And if they really wanted to be cute about it, they could say, well, we've got a band from 3 to 6%. We'll just target the lower part of that band, which is 3%, which we can legitimately do. This is the SARB speaking now. And National Treasury can't really say anything about that because we already have that band, right? So all that, so what I'm saying is that there's not really any way in which, given the pronouncements by the SARB, that they effectively backtrack from these proposals, that 3% will become the new de facto, estimate that the SARB actually moves towards. And the bond market has sort of believed them. The bond market has effectively, and we agree with this, the bond market has effectively begun to assimilate, lower equilibrium inflation to the order. This number will gradually in the fullness of time move towards 3%, and that number will also moderate if I look at what has happened to similarly sized emerging market locations, right? So I wanted to show you that in the fullness of time, we will sort of make this part of our portal. In other words, it will become part of this analysis, and we will be able to put in two different dates here, and I can almost show you then, what has happened from one day to another. But as I showed you, it's really this block and that block that has been responsible for the heavy lifting, with regards to, for example, the compression that we've seen. Okay. One thing that I will close with, right, is obviously the perennial question that we get with regards to where do you see, Reza, now that the curve having compressed? I hope this is going to be big enough for our viewers to actually see. Hopefully that did some justice. Okay, but the common question we get is that to say that, okay, given, Reza, that the curve has now compressed so much, okay, do you not want to now take profits and completely move to the front end, right? Now, I've answered that question partially by showing you that we indeed do have quite a big presence now in the 2032. But if I were to just show you some money market rates, right, some typical front end type rates, if the odd 186 has got an expected return here of 7.7% in the next 12 months, right? A 3-year floating rate note, remember JIBAR now is at 7%. A 3-year floating rate note, if I give it the benefit of saying, okay, what is average JIBAR going to be over the next year? That is actually, in fact, a 1-year swap rate. And I say I get about sort of 120 basis points of credit spread on top of that. Then if you're lucky, you're going to get 8% from front end. So I'm saying floating rate notes for the next year will be 8%. A front end bond like the 186 is going to be less than 8%, 7.7%. But you're still getting from the belly of the curve returns of 11%, right? If I look at the 2037, that's giving 11%. The 2032 is giving sort of close to 11% as well, 10.8, 10.9. So it's saying that you should still be on the curve. You should still have some duration and still be more or less at the belly of the curve, even if you want to have a slightly, almost optimistic and, with regard to how the policy environment can evolve from here. You want to sort of be in the 32s, but I showed you somewhat optimal, a 32s, 37 type of barbell is the way that we think is optimal for now. You don't really want to have all your eggs in the front end, and you certainly don't want to be moving wholesale out of flexible bonds into an income type product where the returns are effectively going to be on the order, increasingly of the order of 7 to 8%, whereas you can still lock in 10 or 11%, even after the curve has compressed so materially, you can lock in 10 or 11%. So the main compression has happened. I will concede that it has already happened. We were on the right side of that. In other words, we had active duration at the time that compression did happen. We took profits, and now we're rotating into something that is a little bit more like a 2032 bond, but we still maintain a little bit of a barbell, having exposure in 2037s as well, right? So I concede that the compression has happened, but there are other parts of a bond's total return that are also of relevance. In other words, you still get roll, you still get pull to par, you still get the carry effect. All of these are additional sources of return that act and that are in force in a longer dated bond that you don't find in a very short dated bond like a 186 or a floating rate note for that matter, right? So the kind of levers that are still at your disposal, even though we don't expect wholesale changes to the yield curve right now, the kind of levers that are still in force with regards to longer dated bonds, the capital gain effect, the pull to par effect, the roll effect, the fact that you're still compounding high initial yields, all of these things, are certainly things that count in your favor and in one's favor when you're thinking about where to position. Okay, so I think I will stop at that point. I'll stop sharing, and we'll go to the floor for some questions. Perhaps I can call on Davi to maybe just sort of assist me with that, and maybe to just start to moderate those questions. I see that there are two there. David, you just want to go through that?
Thanks, Reza. Got nice and technical there towards the end, but we'll maybe delve into a little bit more of that as we go along in the questions. If I can pop you the first one, the SA 10-year bond yield is currently at 9.6, US 10 years at 4.22, and Germany 2.68. And yet net international flows year to date for the SA bond market is still negative. Why is, with such a positive rate, why don't we see more international flows?
I think that will come. So we generally keep a track of that via looking at the consumption of the weekly auctions, right? So there's three main players in the weekly auctions, right? It's the foreign sector, what the question is ostensibly alluding to. They are what's referred to real money accounts that are institutional investors like ourselves that are participating in the auction. And then it's basically the dealer banks, commercial banks, or those that have been gotten a mandate from the Treasury to agree to say, if no one from the foreign sector or from the real money accounts buys the auction, we as the primary dealers will mop up the auction, right? So what we have seen is that US rate that is still above 4% in USD terms has proven to be quite a big opportunity cost for global capital to forego. When looking at the prospect of a high carry emerging market destination like South Africa, where you still face the prospect of currency risk and capital risk in the form of a CDS compensation, for example, let's just say. Now, what has happened? You remember post the financial crisis, that 4% was basically 0%, right? Post the financial crisis, policy rates and the US 10-year was very, very anchored to zero, and in fact it only became a meager 1 or 2% in the years that followed to that. So these were like high times and very popular times for the carry trade. In some sense, with the front end of the US curve being so elevated and the fact that you can lock in over 4% in US deposits, that is a big scuppering factor to why we don't see more foreign participation in the bond market. But that story is changing, right? You're getting increased traction with regards to the disinflation process. The US labor market is weakening. It's not capitulating, but it is weakening. And gradually you will start to see the policy rate taking into account these factors. You might very well see that there's a big chance of a September cut now. But as that US front end starts to moderate downwards, the differential increases, and we will start to see a lot more participation in the weekly auctions, hopefully, as the weeks roll on. It has certainly improved, but it's not anything close to the 40 or 50% that we are used to with regards to what foreigners normally consume of the weekly nominal bond auction. So we watch the space, but the fact that you're getting quite a big bang for your buck in terms of US deposits at the moment at 4% is proving to be quite a scuppering factor.
Yeah, I think that more or less answers the next question as well, but I'll post it to you in any case. With the recent and sort of longer-term one-year performance in the bond space, not just our funds, is it perhaps time to take profit? And then if we look at specifically at flexible bond and our bond Purba Alpha fund, one which allows flex bonds allowing for unconstrained duration management, and bond Purba Alpha, which is more Orbi centric, is it perhaps time either to switch out of bonds into a more income orientated portfolio, or maybe go more Orbi centric like our bond Purba Alpha fund? Yeah. Sorry, a long-winded question there, but
no, sure. But so the idea of bonds in general versus an income fund, I think I've captured some of those sentiments already, right? So the income funds are almost captive to what the outlook for monetary policy is, given that they are generally duration constrained. So the type of animals that can be in that fund, are typically your floating rate notes, your NCDs, your structured deposits, but things that generally have a shorter duration tenor, and those things in turn are fundamentally linked to the stance of monetary policy, which is now on, albeit a slower and shallower cycle, but which is now on the path of a cutting cycle, right? There can be some arguments as to how many more cuts we see, or how long the policy stance stays at this current level, if indeed the 3% inflation does get passed. But undoubtedly, we're not really talking about the beginning of a new hiking cycle for the front end. Nobody's talking about that, right? And since that is now not the case, we can make an argument that you are looking at a declining return profile from the front end, right? Whereas the levers that are still available to you, even though we have seen that compression from taking on some duration in the bond market, even if that is via a very Orbi-centric vehicle, the idea is that you're getting very high initial yields, and you're getting certain return drivers that are in your favor, like the roll effect. We still sit with a very steep yield curve. The roll effect will play into your hands. Many of our bonds are discount bonds, which means that the pull to par effect is also playing into your hands. So all of these are factors which basically, assist the investor in bonds. that the investor in front-end securities does not enjoy. So I still think there's a very strong case to be made for bonds in general versus income funds. Now, the second question as to how do we, let's say they believe me now on that, and they say, okay, we want to be in bonds, but do I go your portable alpha fund, or do I stay in flex bonds, right? And it's simply a function of the kind of journey and the kind of alpha profile that you are after, right? The attraction of flex bonds is that it's always our best investment view. It's duration unconstrained, and but the caveat to that is that there can be some significant dislocations to the ORB from time to time as we take these high conviction views. So if you have the prospect of much greater outperformance through the cycle, but over short terms, there can be some dislocations that can be unpalatable. You've got to take the rough with the smooth in flex bonds. The bond portable alpha fund is the yin to this thing's yang, right? It's the other side of that coin. It's saying that it caters for investors to say that I exactly don't want to have those dislocations. I don't want the ride that flexible bonds is here to offer. I believe in the product. It will add very good alpha over the long term. It's very sexy and all of that. But I just want an ORB-centric type product that doesn't veer too much from the ORB, but consistently churns out maybe 1% over the ORB mathematically every year, right? So where it sits on the spectrum is that the prospect of very material alpha is gone. You will add alpha, but not outsized alpha. There will be 1%, it'll be quite pedestrian, but you will get that with certainty every year, right? Unlike the somewhat of the roller coaster of flex bonds, which for a long-term horizon certainly plays into your favor. The recent performance tables is somewhat attest to that. But you with bond portable alpha, you have a little bit more of a sleep easy South African bond experience that has got very low tracking error, but yet still outperforms by 1% every year. Okay, you won't see it in the performance tables yet because we only launched the fund in September of last year. So by the end of August, in fact, by the end of this year, of this month, we'll have 12 months of track record, and then we can start entering that fund, which also has done quite well, into the table. So very much on the kind of journey that you want and the kind of experience and the kind of alpha appetite that you have will answer the question as to whether you want to be in flex bonds or bond portable alpha. But the general question as to whether you should be in bonds per se, as opposed to income funds, I think I've answered that question.
Yeah, certainly. Thank you. So, I mean, you talked about tracking error there. So bond portable alpha fits right next to a pure passive, except that you're not guaranteed to underperform the index, where our bond portable alpha fund at least give you something above index. Going a little bit more global, Reza, maybe theoretical, or let's see, who's going to fund the US deficit to help bonds when global excess savings are scarce?
Yeah, so actually an interesting question, and this actually harks back to surprisingly what I started out with on tariffs, right? So I think that sometimes in these debates, a lot of guys spin out of orbit without actually remaining anchored in economic identities. I'll give you an example. What am I talking about? A country A, the USA, has got a current account deficit, right? But because the balance of payments must sum to zero, a country that's got a current account deficit must have a financial account surplus, right? Which means that there is another country that has got a current account surplus that is effectively recycling all its investment flows into the US so that the US can have a financial account surplus. Now, to the extent that the US has got a current account deficit, now this part is true, this is factually true, it will always have a financial account surplus. What is the only way that the US can have a current account deficit? It means that they are importing more than they are exporting, right? When they are importing things, they need to pay the other country in dollars. That other country is usually China, is now sitting long dollars. What must they do with the dollars? They recycle it back into US treasuries. And that is exactly why China and Japan are such big holders of US treasuries, was because they got paid for stuff in dollars and they are recycling it back into the US financial asset market so that the US can have a financial account surplus. Now, these things are economic identities. It does not exist because Trump or me or you or Powell or anybody else wants them, but they are just mathematical truisms of how these things interlock together. The US for the foreseeable future will have a current account deficit, and as a result will have a financial account surplus, which means that if it's not China, some other trading partner is going to be sitting long dollars and will need to plow that into the US Treasury market. Now, the interesting question is that the extent to which these investors that are sitting long dollars are price agnostic, right? The empirical record actually shows that they are indeed price agnostic. In other words, if I am sitting with a lot of dollars, I'm China, I'm Vietnam, I'm Cambodia, you name it, I'm sitting long dollars, they almost need to buy US treasuries, whatever the price, right? So I'm not very worried about this question of who funds the deficit. There will always be consumers of US bonds because the other alternative is holding actual US bonds in China, earning simply the covered interest rate parity rate, which is basically going to be very close to zero, right? And that's not a good investment, right? They would rather plow it back into something that is safe and liquid and tradable, like a US Treasury, albeit at a higher yield, right? And the fact that the yields are now going higher is an even more attractive investment case. So I'm not really worried, sir, about this question of who's going to buy the treasuries, because for the very nature of how trade works, there will be a country that is sitting long dollars and they'll need to do something with it. And the safest thing that you can do with it is invest in US treasuries.
Thank you, Reza. There's one more question. We've got 3 minutes left, so see if you can answer it in 3 minutes. When you calculate the yield curve, should move down by 2%, do you apply that 2% to all sections of the yield curve to get the expected returns, or do you have a different expected move on the shorter side versus the longer side?
So yes, we have a very sharp member of the audience, right? Yes. So indeed, yeah. So the graph that I showed you that says that if we are in strongly positive, that the yield curve is going to come down in average, that is effectively a tool that we devised to make the story easier to tell, right? The reality is, but even in its current form, it's quite a lot to digest. The reality is, you remember that distribution diagram I showed you? We've effectively got 4 different versions of that diagram that speak to different parts of the curve. So if I'm in strongly positive, I've got a distribution curve of what happens to the front end, of what happens to the belly, of what happens to the long end, and what happens to the ultra long end. I've got 4 different models that effectively speak to these different areas of the curve. So it's not to say that there's going to be a uniform movement of 2% down. That is just for illustration purposes. But the idea is that we've got a model for every part of that curve, and conditional on wherever those models are or the states that they are in, they will mean different pieces of compression or selling off for different parts of the curve. And that's how we get our expected returns. But actually, to tell that part of a flowing narrative, we simply just say, okay, on average, if I was in this state, what would happen to the curve on average? That is basically just to illustrate. But yes, to now answer the question, there are 4 different models that speak to the different parts of the curve.
Thanks. Well done. A couple of seconds before 12. Thank you, everyone. Thank you, Reza. I hope everyone has a great week from a cold and windy Cape Town. And thank you for attending.